The best long-term hedge against inflation is equity, but within equity, some sectors hold up better than others during periods of high inflation. So in this video, we'll look back in time to see which those sectors were, but we'll also consider where we are in the business cycle, because that also affects our choice of sector. Now, don't forget, if you do enjoy our videos, please do subscribe to our channel. That way you won't miss any of our new content. So now let's look at sectors and inflation and which sectors hold up best in a bit more detail. There are many drivers of inflation. For example, a period of very high wage growth would also increase people's disposable income, and then companies could increase prices for goods and services. That would be called demand pull inflation. Or it could be, as now, that we've got a big spike in energy prices due to a supply shock, and that would have secondary effects pushing up the prices of goods and services which depend on energy. And that would be described as cost push inflation. If your currency depreciates, then you can buy less goods and services if you import them. That's called pass-through inflation. For example, at the moment, we're seeing that in the UK, in Europe, and in Japan. But actually in the US, which has seen its currency strengthen a lot, there it's actually the opposite effect, where its strengthening dollar has actually been disinflationary. If we have a very tight labour market, in other words, lots of job openings for every person looking for work, that tends to push up wages, and that in turn can cause wage push inflation. And then finally, if we have a large expansion in the amount of money which is issued or the amount of credit that's available, that might create demand pull inflation as well. So for example, think of those stimmy checks, those had to be spent, and that created demand for goods and services. So in any period of high inflation, you should always be thinking, what are the drivers this time around, and how do they compare with the ones in the past? Bear that in mind as we look back in time to previous episodes of high inflation. And this is a big caveat for what we're about to see, because no two inflationary periods are exactly the same. But almost anywhere you look right now, you will see high inflation, except for Japan maybe, but 2.6% is high for Japan. What discriminates between each of these different countries is the degree to which each of those factors is contributing to their inflation. In the UK, for example, energy prices have been particularly acute in raising prices of goods and services. And that's because of the way we structured our energy market. Now let's get a feel for what investable sectors are available. What do I mean by investable? Well, I simply mean that there's an exchange-traded fund which can track a particular sector. Now, all the ones you can see beside me here are issued by one company called State Street, and State Street is also the company which created SPY, SPY, the big S&P tracker, which was the first ETF that was out there. Now, what's good about these ETFs is that they have a lot of history, which is why I've chosen them. But what you can see here is a tree representing the correlations between the individual funds. The way this works is that if two of these funds are close together on the tree, such as industrials and materials, that tells you that they're highly correlated. Similarly, consumer discretionary and technology are very highly correlated. But industrials and utilities, for example, have a very low correlation. So what this tree lets you see is which of the funds move up and down together in price much of the time. And you can also see the groupings of funds very clearly. So for example, all of the funds in these two top branches, which branch off together at this point in the tree, all of those would be considered cyclical sectors. And that's because during a period of growth, they'd be expected to do well. Whereas in a recession, you'd expect them to do quite badly. Whereas the sectors in the bottom half here, which are shown in blue, are generally defensives, with one exception, which is real estate. So in a recession, for example, you choose one of these defensives like healthcare, consumer staples, and utilities, because they won't lose as much as the main index or the cyclical funds above. Now, what's interesting is that these three cluster together, and the reason for that is that actually they contain some really big tech names. So although you might not think of consumer discretionary or communication services as being tech sectors, they contain some big tech names, as we'll see. This is the excellent FinViz website, which lets you see the S&P 500, where each of these squares represents the market capitalization of one stock in the index. Furthermore, these stocks are actually grouped by sector. So we've got the tech sector in this square, and that itself is broken down into subsectors, such as software infrastructure, semiconductors, information technology, and you can see it's dominated by two big names, Microsoft and Apple. If we look at communication services, it contains Alphabet, previously known as Google, and Meta, previously known as Facebook. Now you might have thought those were tech companies, but not so. Also, it contains companies which have streaming media such as Disney and Netflix. And if we look at consumer cyclicals, it's dominated by two big names, and that's Amazon and Tesla. Now, consumer cyclicals is what we'll refer to as consumer discretionary in the rest of this presentation. Now, the colors of these blocks represent the losses or gains during the course of 2022. Notice how much of the S&P 500 is a sea of red, particularly these tech mega caps. But there is a sea of green here with positive returns, and that's in the energy sector. You'll also notice that defensives like healthcare are also largely green, as are utilities down here, although that's a fairly small sector. Another way to think about sectors is in terms of risk and return. So on the x-axis here, we have the risk of the individual fund based on return since 2018. So for example, energy has a very high risk as measured by volatility. That's the annual typical price fluctuation, whereas consumer staples, which is one of our defensives, has a very low volatility, as do the other defensives, which are healthcare and utilities. Then on the y-axis, we've got return, and you can see that technology has had a great return relative to the other sectors over this fairly short time period. If we exclude the funds which only came into existence recently, that means we can push our analysis further back in time. Now we can go all the way back to 1998, so we have about 25 years of data. You can see that the defensive sectors, healthcare, utilities, and consumer staples, still have a relatively low volatility, but now over this period, consumer discretionary is doing much better than technology, say. And what characterizes energy and financials is very high volatility. So that should give you a feel for the risk and return you'd expect for these different sectors. If you are going to be buying energy or financials, just be ready for a rough ride. And of course, in 2022, the same goes for technology. Now that we've got a feeling for the sectors themselves, let's look at what happened this year. This graph shows the cumulative return over the course of 2022 until the time I made this video. Now, one sector really stands out, and that's energy as being the best performer. It's up 47% this year. The next best performing sector is one of our defensive sectors, that's utilities, which is also up over the course of the year. Consumer staples also held up fairly well, it's only down by 4%, and you can see a lot of the cyclical sectors are the ones which have sold off the most. So that's communication services. Remember, that's got Google and Facebook, now Alphabet and Meta, and consumer discretionary is dominated by Amazon and Tesla. So you're probably thinking, well, it's a no-brainer, I'll just buy energy and I'll be fine. But I'd hold your horses, because if you actually look at the price of oil in the United States, it's actually peaked some time ago, and it's been coming down fairly quickly since. That's not to say it won't rise again, of course it could, but just be aware that commodities can turn around very quickly. So if we do start to see a fall in oil price, then all the gains in XLE, which we've seen so far, could very quickly reverse. So it's possible that you've missed the boat for that hedge, but don't worry, there are others. Now in Europe, it's a very different situation. So for example, if you look at natural gas prices in Europe, and here's a post by the brilliant Javier Blas, where he's showing the huge spike upwards in gas prices. Now the futures market also has a delivery point, and this is for delivery in the Netherlands. So the price that we've reached for European natural gas, but also the rate at which prices are increasing, is completely unprecedented. So perhaps in Europe, that hedge would work for longer given the restricted supply of gas from Russia. However, again, the problem might be that if there is a resolution of the situation, these prices could turn around very quickly. Also, don't confuse energy suppliers and energy producers. The companies which are mostly profiting from this spike in prices are the upstream energy producers, not the ones which actually deliver energy into your house necessarily. Now, before I move on to the long-term sectoral analysis, let me just quickly mention our membership, which we run on our website, PensionCraft.com, where you get access to lots of goodies, such as lots of members-only videos, plus you can use Slack and ask me a question anytime you like, or interact with other members of our growing community. Now, if you do want to learn more about that, just click on the link beside me or in the description beneath me. We saw that the spider data goes back to 1998. If we want to go back further, we're going to use data from Kenneth French. If you think you've heard the name before, it's because he's half of Pharma and French, the guys who revolutionized factor research. But he makes available data on sectors in the US going back to 1926. Now, the difficulty is that some of those sectors have changed in nature. For example, there wasn't really a sector for computer software or computer hardware in the 1930s. But if I just restrict it to periods when all of the sectors had data available, it goes back to 1969. And these are the annualized returns since then. Now, this is a kind of ESG nightmare because the three things at the top are tobacco products, defense, and beer and liquor. The things which are at the bottom are things like precious metals, recreation, steelworks, and coal. But on the whole, you can see that the US has had very strong returns for a very long period of time across multiple sectors. If we look at those three best performing ESG nightmare sectors and three of the worst performing sectors, you can see there is a massive wedge between the two. But I wouldn't write off gold quite yet. As we'll see, during periods of inflation, it really shines. Now let's look at what happens to those sector returns when inflation's high. So this is US inflation going back to 1926 when our dataset begins. And you can see I've banded it into three different regions. If inflation's above 3.6%, it's called high. If it's below 1.7%, it's called low. And if it's between those two, it's called medium. Now these bands look actually very close together. What I've actually done is group it so that the number of months in each of the three groups is roughly equal. So just to whet our appetite, let's focus on this decade, which is the Volcker era. Here are the sector returns for that decade between 1972 and 1983. And there is a really standout sector here, which is called gold, and that represents precious metals mining companies. Another one which really stands out is the healthcare sector, which is one of our defensive sectors. Now, every one of these inflationary periods will be different. One example of that is what's called here guns. That represents the defense sector, and this was actually a period of very rapid growth in US government defense spending. That probably also bleeds over into the aero sector here, because, for example, some of these manufacturers would also be creating fighter jets. And if we look amongst the worst performers during that period, it would include a lot of cyclicals like banks, but also some consumer discretionary spending. So what's called soda here represents candy and soda companies. Toys actually represents recreation. So what people tend to do when they're tightening their belt and inflation's taken money out of their disposable income, they cut back on unnecessary things, discretionary items like candy, like beer, and recreation. And that's a general lesson that we'll see in a moment. So what I've done here is to look at those high and low periods of inflation, and I've calculated the median return for each sector during high inflation and low inflation and subtracted one from the other. So the bars which you can see in blue here at the top are the sectors where performance was actually better during periods of high inflation than during periods of low inflation. Whereas most of the bars, most of the sectors have a negative effect. That's because equity generally dislikes high inflation. And if we look at the sectors which held up best, precious metals comes out on top. Agriculture is also a strong performer, regardless of inflation, because I guess people still have to eat. Often agricultural prices will themselves be a driver of inflation if wheat prices spike, as they did in the 70s, for example, and of course petroleum and natural gas, another regular source of inflation shocks driven by supply shocks. Insurance is something which I guess you always need, even if there's a high inflation period. And what's interesting is that generally beer and liquor do pretty well, unlike that 1970s period. Take from that what you will. And then again, at the bottom of the table, we see things like recreation, where people are tightening their belts and reducing their discretionary spend. We'd also expect for companies to tighten their belts. So for example, in aviation, maybe they cut back on new aircraft orders when inflation's high or when energy prices are high, or companies might cut back on their IT spend. Also, for big ticket items for households, things like automobile and truck manufacturers do poorly during periods of high inflation. So the general pattern is that consumer staples, such as food, personal services, those tend to hold up fairly well, whereas consumer discretionary does badly. Now, when we're choosing sectors, we can't just think about inflation, we also have to consider where we are in terms of the business cycle. What we mean by that is, where are we in terms of the waxing and waning of GDP growth? Now, during a period of expansion, when growth is about to reach its peak, companies will generally be increasing their capital expenditure because there'll be brisk demand for their goods and services, and generally interest rates will be increasing during this period. In that kind of environment, financials and tech will do very well. You could argue we've been in that phase for the last decade. The sectors which perform badly in that kind of environment are the defensives like healthcare and utilities, but also consumer staples. The next part of the cycle is probably where we are now, which is a slowdown. Here, growth is still positive but decelerating. Actually, in much of the developed world, it's already turned negative. But also, the key thing here is more restrictive monetary policy, which we're getting plenty of right now. In this kind of environment, defensives do much better. So consumer staples, healthcare, but also industrials. The sectors which suffer are consumer discretionary and real estate, but also materials. Because remember, if there's slower growth, there's less demand for raw materials. Then once you actually enter a recession, you'd expect to see unemployment increasing, low consumer confidence, which we've got certainly at the moment, and easing monetary policy, which we certainly don't have at the moment. So I think this is one of the difficulties, which is that this is an unconventional cycle because inflation's so high. And that's why central banks will carry on increasing interest rates even though there's a recession. They're unlikely to pivot when inflation's so high. But in this kind of environment, it's still defensives, so consumer staples and utilities and healthcare, which do well. And the sectors which do badly are the cyclical ones, so that's real estate, technology, and communication services. And then finally, as things start to improve, you rotate back into the cyclicals, like consumer discretionary and real estate, and move out of the defensives, like consumer staples and utilities. In conclusion then, we saw that energy's been a great hedge so far, but I think given the price of energy starting to come down in the US, you might be too late for that. Also bear in mind the very rapid reversal that we've seen in the past in energy prices, and your hedge could turn into something that drags down your performance very quickly. Given where we are in the business cycle, as well as considering inflation, the sectors that might do well would be things like consumer staples, utilities, healthcare, and of course gold, by which I mean companies which are related to gold production. Now, there are some caveats. Most importantly, I think tapering hasn't really started yet. The Fed's balance sheet is still about $9 trillion, and it really hasn't shrunk much. So there might be some surprises in store there. But I think it's fair to say that you should probably avoid cyclicals, so things like consumer discretionary stocks, and that would include things like Netflix, streaming services that people would cut back on, also things like Amazon, but also real estate. We haven't really seen interest rates start to bite in the housing market, but I suspect that's going to come. Also, tech is very cyclical, and it may be that companies start to cut back on their IT spend. That's certainly what we've seen in previous cycles. And also, people cut back on fun. So recreation tends to suffer during periods of high inflation, although interestingly, not beer and liquor. So as we enter this period of lower growth, high inflation, and increasingly restrictive monetary policy from central banks, I think a bit more caution is warranted. But fortunately, a lot of those defensive sectors are also the ones that hold up well when inflation's high. So that makes the allocation easier. Now, don't forget our offer. If you want to join our community, you'll find a link beside me and in the description beneath me to learn more about that. And as always, thank you for listening.